In fact, go across to Sanjay Parekh joining us at this point. Soham Asset Managers joining us. Great having you here, Sanjay. What are you doing in markets these days?
Good afternoon. So, we are a large cap dominated fund. Our mandate is to always have 70% into large cap. Right now, we are 82% into large cap because we believe that larger caps will be better insulated in this environment where the macro, we certainly have macro headwinds. On middle small cap, we are selectively buying. We are open to it, but we need a much higher margin of safety. And broadly, we are domestic overweight, global underweight. That's the theme that we're following, and it has helped our fund.
Mr. Parekh, good to know that. Good afternoon. This is Snehi also joining in the conversation. You did say that you have a very heavy exposure, about 83% in large caps. Talk to us about where you've gone shopping recently within that basket.
Yeah, so, in Feb, we were at 70 to 73%. So we pivoted in March and towards April now, April and early May. So essentially, like in oil and gas, we have the largest conglomerate, which we felt Reliance would be better off in this environment. And we are not taking any advantageous gains or losses. But beyond this, at least we believe that globally refining and petchem capacities, assuming this gets subsided, the war, which is a very big life, but ultimately it will come to a logical conclusion. And after that, the refining and petchem capacities will take some time to, revive back. But even if we don't take those gains, at the enterprise that we had, we found a lot of value. So that's where we increased dramatically. And then, of course, selectively in financials, where we still feel that valuations are comfortable, there we added. And then in select industrials, we added. And that's how but broadly, domestic plays, that's where we increase our exposure to large caps.
And Sanjay, in terms of, again, the tilt, let me try and get an understanding. One large private sector bank came out with very strong numbers today. Largely, the larger private sector banks have now started to trade at a significant discount to 5-year averages. Is that one of the pockets that you look for? And even within that pack, there are quite a few. What are the differentiators that you're looking for within that pack, if you're positive on those?
Yeah, so we have all the larger banks. So we have SBI, ICICI, Axis, and HDFC Bank all put together as a basket at 26-27%. We like this basket because the provisioning are quite good. They have excess provisions, all of them as a basket. Clearly, the franchise is stronger. The asset quality for all of them, barring SBI, which will show results ahead, is very, very benign. So in case there is some stress because of the war, they are far better placed. And most importantly, the valuations are really reasonable. So while they're not delivered, in the recent times, but we really believe that, they are very, very well poised. And the credit growth also is slowly getting better. And interest rates, for sure, now we can say that it's bottomed out. When it would rise is a question, but very clearly the interest rates are bottomed out. So if in a rising interest rate environment, if the loan growth is, let's say, 15-16%, the NII growth logically should be a little higher. And that is what we see, that last year was a headwind on NII growth being lower than the loan growth, and loan growth itself being lower. This year, we are seeing a revival in loan growth, and NII growth will be a little better than loan growth. And all the 4 banks are well poised for it.
Okay, so that's your take on banks. Mr. Parekh, we've seen some of the consumption numbers also come out, and so far, either updates or earnings have all beat street estimates. What is your take on that sector? Have you been buying anything fresh when it comes to some of the large cap FMCG names?
Yeah, so we don't own FMCG because we found valuations discomforting. Yes, they have been a little ahead of times. Nestle, even HUL in terms of volume growth rate. But we still feel that on sustainable basis, the growth has to get better for the valuations that it has. So we are very positive on domestic consumer space. It's just that, valuation is what is discomforting us. And hence we would want to play consumption through, other investments, maybe in discretionary side, or even in telecom, or even in real estate. At least we believe consumer is, the FMCG space for the growth is not that cheap.
Okay, you suggested Reliance, Sanjay. That was one of your one of the stocks that you mentioned is something that looked interesting. We've seen a decent rally on the stock price as well. Still looking interesting, or it was interesting prior to the rally?
Yeah, no, we had it last month, so it was at much lower levels. And we really believe that, at around 1350, 1360 is broadly where we've added. We really felt that this return is quite favorable. If you take the base EBITDA of refining and petchem at 60,000 crores, and that can only get better from here on. The oil and gas EBITDA is more like 16, 17,000 crores. And then the telecom piece is doing well. The retail piece, they're trying to consolidate, but they are certainly getting their act together. If you take all the businesses in terms of, the multiples, and you take a SOTP, the value according to us is coming to at least 1660, 1670 rupees on 28, which is a very decent upside in the large cap space, in the largest market cap. So, and then on the new energy also, they're really, the execution is on. You'll see that results coming in 12 to 36 months, and meaningfully it will become a very large play, and it'll be a complete integrated play in the renewable space. So right from solar to, completely integrated, the battery storage, even integration to the level they can in that space in terms of certain chemicals that they need. So they clearly have a right to win in that space as well. And it will show up meaningfully in 28, 29, 30. But I still feel there as well, it's a very, very good capital allocation for them. So overall, risk return was quite favorable, and we're still positive, over the next 12 months to 36 months.
Okay, so that's your take on Reliance and the entire energy basket. But Mr. Parekh, stay on with us. We'll slip into a very short break. Viewers, we'll come back and continue the conversation with Mr. Sanjay Parekh on the other side, so stay tuned.
You've spoken a little bit about how you like Reliance, how maybe some of the private sector banks selectively look good as well. Talk to us about other sectors, pockets, spaces, ideas that you're tapping into.
Yes, so we like the discretionary space, Maruti, Mahindra, and all of them we own, Samvardhan Motherson. Of course, Samvardhan Motherson is a global company which may have some headwinds in the near term. But Maruti and Mahindra's numbers in April, volume numbers have been very good, Of course, there could be a petrol diesel price rise, because I don't think, it's sustainable for the government and oil companies not to increase prices, and that may impact demand. But structurally, we like both the spaces in discretionary consumption space. So that's what we like. Cement in the near term results were mixed. They have increased prices due to the cost inflation. And the demand supply, overall, there is clearly overcapacity. But the larger players will consolidate, and we have both of them, Ambuja and Grasim, Ultratech through Grasim. So that's how we are positioned. And then in telecom, we have Bharti. We have Adani Port in ports. and then Larsen Toubro in the capital goods, and Interarc, which is a small niche prefab company in the capital goods space.
Okay, so that sounds like an interesting mix of stocks you have there. Mr. Parekh, on the flip side, any sector you feel is structurally over-owned right now? You're seeing a lot of overcrowding over there and something you'd like to perhaps avoid at the moment?
Not really. I mean,
Okay.
you look at ownership, but more so we look at valuation. So we are hardcore GARP investors. Our price earning on the portfolio is 14 times on FY28. For growth rate, much higher than Nifty, which is our benchmark, and ROE is higher. So we look up to growth at reasonable price, and we're very conscious of not overpaying for growth. And that's how our stock selection is. And the idea is to identify 15, 20 names in Nifty and not have 30 names, and then a few more large caps, and then middle small caps if there's a real higher price value divergence. Now, that's the way we position our portfolio, and by and large, it's worked very well with our 18% compounding in little less than 4 years. So that's the strategy that we are on.
Okay, and Sanjay, give us a sense. There are very real risks on ground which are translating, right? Which are yet to translate. Talk about higher crude prices. Brent is in fact at 110 a barrel now. That's one of the bigger risks. And the pricing, currently everything's been cushioned by the OMCs. That could well unwind at some point of time over the next few weeks. Talk to us about what that could do to earnings. And I ask you this question because you spoke about how Reliance's earnings 2 years forward is how you are looking at the stock maybe a month or so back. So how do you look at the Nifty earnings now and what the risks could be and whether risk reward there is favorable, how you're justifying it?
Very, very valid point. There is a risk. The macro, we have a headwind. We've seen this chief economic advisor suggesting caution because of the reasons that you mentioned. There are logistics challenges, there's cost inflation. Very clearly, global oil prices are very high, which is a very weak vein for us in India. So for 5 million barrels daily to be imported, it's a daily outflow of $40 at least more than, the normal $60, $65. So that's a $200 million impact on exchequer, whoever bears it, government, oil companies, not yet individuals, but effectively it will be passed on. So even if it's partially. So overall, this certainly will have impact on earnings. You will see cost inflation. Q1, according to us, will be weak. It's very dynamic as to when does this war end. Even if it still significantly reduces, we'll see impact on Q1. But then at least Q2 onwards, we should get better. Also, we have to, monsoons are what we look up to. It does impact rural demand and overall demand also. So these are the factors which can become headwinds for us. Some of it is real now. And hence, we certainly want to, at least at our end, we are very positive for longer term. But being aware that in the near term, Q1 is weak and we may see some reaction in markets, maybe 3-4% from here. And hence, we are telling our clients to slowly accumulate. And that's our strategy right now.
Okay. Mr. Parekh, how are you participating in the Pharma pack right now? What is your ownership over there, given that, first CDMO was such a big theme? Now, semaglutide is also emerging as one big theme, wherein Indian players are now starting to get international approvals for their generic Ozempic versions. Any stocks that you like from Pharma, or how are you reading this entire basket?
Yeah, so, what you mentioned, we're not there yet in that space. But Sun Pharma is recently, after the acquisition that they announced and the whole rationale after the call, we really found it quite convincing. We used to own it last year, which we had sold, and it was practically available at the same price. And hence we increased our exposure because we really believe that the Organon acquisition makes a lot of sense. They bought it at very, very reasonable valuation of 6.5 times. Even if it's a flat earning, the overall synergy will build up over 1 to 3 years. And that will get growth for Sun Pharma without any dilution. And we're not so worried about the financial risk because they will throw up cash flows in the next 1 year as well. And by then, the net cash will further increase. And at 6% cost of borrowing, we're not so worried about the overall debt going up. So it will certainly get back Sun to a growth trajectory. And if it's come without any dilution, it's perfectly fine. So we're not worried about financial risk. We like the strategy. And we think there is clearly earnings leg up on 28, 29, more than 28, 29. And that will look up quite well. And then it was very reasonable. So that's how we added Sun Pharma. And then other one we have Aurobindo. Encure also we had, but we recently booked profits because we thought it's run ahead of times.
Okay, Sanjay, you've been candid. Thank you so much for coming in and speaking to us. Crucial little nuggets coming out from that conversation.
Thank you.
All right, and viewers, we'll slip into a very short break. We'll continue coverage, continue to talk stock specific on the other side of this break. Stay with us.